All right. I'm going to kick off then. Thank you everyone for joining. I'm sure we'll have some other folks come in the next few minutes. So as everyone knows, today's webinar is a little bit different than our typical webinars. Not so much of a presentation. We are really just having an Ask the Experts session on employee ownership trusts, which we will refer to as EOTs throughout the presentation. And so really, most of the folks on this webinar have probably looked at the EOT as an exit option for selling 51% or more of a business. And what happens, as I'm sure all of you know, is once you start looking at it from a high level, and you can get a tremendous amount of kind of high level resources on our website, actually, the Employee Ownership Canada website, our resource library. Your questions come up, right? Specific to the business that you're considering, whether it's your business or a client's business. And those questions can get pretty technical pretty quickly. And so we wanted to provide an opportunity to have folks come and ask questions to the real experts. And the truth is, this is a new legal structure, right? It's a new exit option for business owners. And so there aren't that many experts out there that really can answer your questions. Your typical corporate accountant, typical corporate lawyer is not going to know much about the employee ownership trust just yet. And so we have brought two outstanding and experienced professionals here today to answer those questions. So if we want to change slides, Charlene, um, we have we're very, very fortunate to have Sinjin McCloskey and Jennifer Williams with us today. So I'm going to briefly introduce our two speakers. Sinjin might be Canada's most experienced tax lawyer on employee ownership trusts. There haven't been that many transactions just yet, but a half a dozen, possibly, give or take
Yeah.
one or two more. And Sinjin has worked on multiple of these transactions. So we are incredibly lucky to have him here today to answer our questions. There's no experience like actually doing the work. And so that's what we've brought you all today is these two folks have done this work. Sinjin is a tax associate with Clark Wilson LLP in Vancouver. His practice covers tax planning, business succession, and the legal and tax structures that underpin employee ownership trust transactions in Canada. He holds a Master's of Laws and Taxation from the Peter A. Allard School of Law at UBC, and he's called to the bar in British Columbia and Connecticut. He's written extensively on EOTs, including a very widely read tax alert on the recently legislated permanence of the $10 million capital gains tax exemption. I'm sure everyone on the call knows about that tax exemption. It was made permanent in April, which is great. Originally, it only had 2 years, but now it is permanent, and that is eligible for business sales to an EOT. And he is recognized across the sector as a trusted technical voice on employee ownership law and tax. Sinjin's clients appreciate his meticulous approach and his ability to explain complex tax scenarios in plain language. We all love when lawyers and accountants can do that, especially when the stakes of a succession decision are high. So really, really grateful to have Sinjin here today. And in addition, we have Jennifer Williams, who is also one of the most experienced folks in Canada on employee ownership trusts. She's the founder of Ownership Design Group. It just recently changed names. It used to be known as Firefly Insights. So you probably know of Firefly Insights if you've been looking into EOTs. Ownership Design Group may be a new name for you. And Jennifer is the founder. And again, to my knowledge, there are two firms in Canada who have actually gone through the process with a client of planning, designing, and executing an employee ownership trust transaction. And Jennifer's firm is one of those two. So really, very fortunate to have her here today to answer questions. And Jennifer brings more than a decade of experience in employee ownership and succession planning across industries and company sizes. She herself is a three times business owner. She's the former CEO of an employee-owned company, and she brings a firsthand understanding of the financial, emotional, and practical dimensions of a business transaction, not just as an advisor, but as someone who's actually been in the seller's seat herself. She founded Ownership Design Group to help business owners transition successfully, preserve what they've built, and strengthen the employee engagement that makes employee ownership work. And Jennifer's perspective is grounded in both human and technical realities of the process. And as many of you know, I'm sure employee ownership transactions are there's a lot of people involved. So we're very, very fortunate today to have these two here. I will very briefly go over the agenda if you want to change slides, Charlene. I think, there we go, perfect. So I've already gone over the welcome, all done there. We did receive about a dozen really great questions from folks. So to anyone who submitted questions, thank you so much. That was really helpful. We'll spend, I think, probably about 30 minutes, maybe a little bit less, answering those questions. And then we're just going to open the floor. And so you can use we love the hand raise tool. We love when people verbally ask questions. It's really helpful. But if you're not comfortable doing that, you can use the chat function as well and type your questions. And with that, I am going to let Sinjin and Jennifer take it away and start on these great questions that we got.
Sure. Hello, everyone. Good afternoon, good morning, depending on where you are. So we'll try and tackle the questions kind of without all of the background information. And if people have questions about the questions, you can feel free to add those to the chat. So the first question that we got was, can you outline the process for setting up an EOT and what's the typical timeline? And so in our experience, having done this a few times, the process typically involves a feasibility to assess the readiness of the company, both in terms of its financial capability to make the transaction happen, but also the people and the succession plan from not just an ownership perspective, but also from a management perspective. That feasibility process for us takes 4 to 6 weeks. And at the end of that gives people a really good idea of, is an employee ownership trust right for you? Are there things you need to work on before you can go forward with the design of an EOT? Or is it not right for you? Is this not the right tool for you to use in your business? From there, if clients decide to move forward, the typical timeline to set up an EOT, assuming you have a valuation up already and that you're not waiting for evaluation or you're not waiting for your fiscal year end to get the valuation, the typical timeline is about a year from start to finish. We've done it in less, we've done it in more. And so typically, one of the things we say to people is it's important to start planning early because these things can take time. But typically, give yourself 12 to 18 months to make sure you have enough runway to get that done. And Charlene, are you controlling the slides? Perfect. Thank you. Are there typical pitfalls that people miss when setting up an EOT that cause them to be far from optimal? So Sinjin's going to talk a lot about tax. And I think, one of the reasons that people are incentivized to do an EOT is for tax reasons. And there are very clear guidelines from the Canadian government on what need to happen to make sure that you meet those regulatory requirements. So that is one thing you want to make sure you have the right advice. And Sinjin, you want to jump in there?
Yeah, I do want to jump in and mention that although they give somewhat clear advice, I would say that there are a couple of pitfalls that I haven't seen anybody fall into them yet, because so far there's only a small number of very interested advisors who are talking about this. But there are some pitfalls that I won't say that people typically miss because it hasn't happened yet, but there are definitely some pitfalls that I could see someone missing by accident. I see people coming in the door saying, "Oh, hey, can I do XYZ thing?" And the answer is generally yes, but there's a specific way we have to do it. So, which we can talk more about later, but.
Yeah. And the other thing I would say is that if you look, so the UK has been doing employee ownership trust since 2014. We've only been doing it for a year and a half. So we don't have as many examples of pitfalls. But the thing from the UK that is kind of the greatest lesson learned is that when people stop investing in their employee ownership trust once the transaction is complete, like the transaction is actually the starting line to embedding employee ownership into your company. And so it's really important that when people think about this is typically a sale transaction to the trust. So an owner can exit, but the company has to be willing to take on employee ownership in its culture and its practices and the way it operates moving forward. And so that is the biggest lesson learned from the UK. And if you really want to unlock the benefits that come from employee ownership, ensuring that you include that in the work after the transaction is critical for success. So this question, this person has loyal, dedicated employees and their compensation includes profit sharing. But they have some challenges navigating differences, conflict, HR issues. And so the concern is that a transition to employee ownership would this address the challenge or would it make it worse? And so, and fair, because if you already have those issues in your company, you don't want to make them worse. One of the things I would say that we see in our clients is that once they become employee owned, they're aligned to a common goal that doesn't exist necessarily when people are profit sharing. In particular, if profit sharing is based on deliverables that may have a sales team opposite an ops team where they're in basically competition. You've got somebody promising sales that ops can't deliver on, and then their bonuses are compromised because ops can't deliver on the sale, for example. So one of the things that's key in employee ownership is information sharing and education, and making sure that people share that same information and are aligned to common objectives. And so if you were to just do a transaction where you transition to employee ownership and you don't also work on aligning people to the common goals, you may continue to face those challenges. I don't think they would necessarily get worse, but they would continue to persist. And I would say that it's worth doing the work to make sure those go away in any case for your business overall.
So we've heard this question a couple of times before. So what does it mean to be arm's length? Do I have to worry about the fact that I have this employer-employee relationship with the would-be purchasers? Now, in fact, it's not going to be the employees themselves who are going to be purchasing. It's a trust for the benefit of the employees, but you probably are going to have you're going to have at least some employees as trustees. And so we might worry, if they're scared to negotiate, are we really arm's length? And the arm's length question, there are some people who are deemed by the Income Tax Act to be not at arm's length. So you're never going to be able to deal at arm's length with a spouse, with a child, that kind of thing. But for any other sort of relationship that's not deemed to be not arm's length, it's just a factual question. It'll just come down to, are you actually bargaining with one mind or not? One of the things that we've seen, become somewhat popular in these transactions is to set up an arm's length trustee agent. So someone who's not a beneficiary, who's going to act as agent for the trustees, or for the trust that's not formed yet. And I think that's a pretty good way to make sure that you're very clear, hey, we're really arm's length here. There's no real risk of us sort of colluding, and the best evidence for that is actually disagreement, right? Like if you can actually show, hey, we actually bargained on a couple of points, either maybe the purchase price, maybe, the timing of payments, like the terms of any kind of loan, certainly, due diligence, right? To say, hey, I don't think we actually have to do this much due diligence, or yes, I do. That kind of thing can really help to establish a sort of arm's length relationship. And then this is something that, again, a lot of folks, I think, there's a lot of folks who hear the term employee ownership trust and say, I don't know what that is, but I like it. And there's a lot of folks who hear the term employee ownership trust and they say, I don't know what that is, but I don't like it. And both of those people may be wrong. And the question here, I think, may be coming from someone who says, I don't know what employee ownership trust is, but I like it. Because if you already have broad employee ownership, if they're already actually holding shares, that actually might make it very hard to transition to an EOT. And the reason I say it's not impossible, we've seen some very large EOTs that were already entirely employee owned. But it depends on the percentages. So if they are holding, there are particular rules that I don't think we need to get to the weeds about, but there are particular percentages of shares of various classes, you kind of have to look at, okay, how much of each class are owned by each individual, and are they selling to the EOT as part of this transaction, right? So if they are, they're not going to be beneficiaries. And so what you don't want to do is you don't want to say, oh, I'm going to set up a trust for the benefit of the employees who are not selling shares to the trust, and then have all the employees sell shares to the trust, because now you got a trust with no beneficiaries, right? So I wouldn't say I wouldn't say that it's impossible to be arm's length. I would just say that there are these technical requirements you got to be careful of. And again, they're not impossible to work your way around. I mean, if for example, you find that maybe it will make sense to say, what, we're gonna have the EOT buy 51% now, and maybe there's a way to arrange that so that those are all departing employees, or those are all, the sort of like majority owner already exists, and that's the person who's selling, or there's lots of different ways you could make it work. But there are also ways that you might not be able to make it work. If everybody already owns the shares of the company equally, and it's a relatively small number of employees, an EOT might actually just not be possible.
Okay. How is the sale price determined? And evaluation should or must be completed? And can the agreed upon price be either the higher or lower than the range determined in the valuation? So under the legislation, an EOT does require an independent valuation done by a certified business valuator. And indeed, a valuator will give you a range. All of my clients have used the midpoint of the range as an agreed upon proposal to the trust to acquire the shares, and that was what felt fair in those cases. Going outside of the range, St. John, maybe you can, presumably could you go lower, St. John? I haven't had a client try and go lower. Higher would be a challenge, but I wonder if you've seen anyone go lower.
I've heard people ask about lower. My general advice would be don't go lower, just go at, like, you should be selling at fair market value. If you sell at less than fair market value, that makes it look less like it's an arm's length transaction, which is what you want. You need it to be an arm's length transaction. Not that I think the CRA is going to come bully you if you're trying to do your employees a favor. I mean, maybe, like they enforce the law as they see it, right? So if they think that it really wasn't an arm's length transaction, even if it was one that was not arm's length to hurt you, they still could, in theory, say, well, it's not arm's length, and so therefore this is not, this wasn't an EOT transition. But the main thing to me is there's no reason you can't take it as debt now, take the full value as debt now, and then at some later time, if you decide, hey, you know what, I actually now I want to forgive some of that debt, right? That's totally fine. But I would tell a departing owner, like, hey, you know what, if this thing goes gangbusters a year after you leave, you built the foundation of it. You should feel like you shouldn't feel weird about hanging on to this debt. And then if everything's going great, like, feel free to take it, right? Why not?
Right. Which banks are open to providing financing for an EOT so that sellers can take home some cash at close? So what I can share is that there are many different banks that are financing EOTs. I've had clients work with some of the different big 5 banks. I know that BDC is also interested in financing business transitions and EOTs. I know Meridian Credit Union has gotten behind it. So at this point, as long as the business has the cash flow to finance the financing and afford it, the banks are interested and willing.
So, is there a more valuable benefit method for employees from a tax standpoint between profit distribution and equity payouts? So I would say the equity side of this. So in my estimation, upon reading these rules, I see this legislation as Canada saying, hey, the UK has this EOT model and we like it, it works. And their model is based entirely on basically profit distribution. So it's the trusts distribute the income of the trust. So the trusts receive income from the company, usually in the form of dividends, and then distributes that income to its beneficiaries. So somewhere along the line, somebody at finance said, "Hey, wait a second. The U.S. has a similar model. They call it an ESOP. It's a little different from our ESOPs, but there it's a trust and it's got a sort of equity concept, right? So it's more of a retirement vehicle than a profit sharing vehicle." And I think there was an idea of, well, we should let people do that too. And so I think the equity component has kind of been added on to the UK legislation similar to the UK. And so what equity payouts actually look like, we don't really know yet. I would say in terms of if there's a more value, is there a better tax result using equity? I could imagine that there might be, but I would say at this stage, because it's so early and this legislation is, it's new in Canada, and the fact that it's so flexible is new, right? So the UK is much less flexible. The US is much less flexible. Canada has said, go nuts, do whatever you want, which is really exciting. But the first couple of people who really want to focus on that equity component, I think it's going to take a bit of time. I think we're probably going to be looking at asking for rulings on these things for how the CRA wants to see them work. And so I could imagine a world in which there is a better result from an equity distribution if we can find a way to get that equity component maybe to the employees in the form of shares one day, and they can take their lifetime capital gains exemption or whatever. There's various ways that it might go. But I also could imagine the CRA saying, no, you know what, this is all in respect of your employment. You only get this benefit because you're an employee, and so it's all income. And if that's the case, then I would say there's no difference between the profit distribution and the equity approach.
I'll just add that to be clear, right, that profits that flow to the trust typically flow as dividends, and so they flow to employees as dividends, and so they're taxed as dividends, which is more tax efficient than a bonus or employment income for employees. So that is one benefit. And yeah, on the equity / internal capital accounts that we're allowed to have in Canada, it's unlikely those will have any of the lifetime capital gains exemption benefits that go with holding shares directly in a company. Yeah. So from a tax perspective for employees, like dividend distribution is pretty much as tax effective as you're going to get in this structure.
Yeah, it's probably not going to get better than that. I mean, it might. Like I said, there are some avenues I could imagine. Again, it's very the legislation is very flexible. But it'll come down to how the CRA wants to interpret it. So in terms of, again, the benefit method, I think it'll be similar, but the equity side, setting it up might have higher upfront costs to the departing owner, right? When in terms of transaction costs, they're going to need to actually think about, okay, how is that going to look? During the design and setup process, how do you mitigate the risk that the CRA can claw back the exemption? So the way that you mitigate the risk against the clawback, so there's this $10 million capital gains exemption that's available. And you want to make sure, of course, that doesn't get clawed back. That gets clawed back by the CRA from the owner in the first 2 years if the trust ceases to be an employee ownership trust. And after that, from the trust for 10 years. So how do you mitigate it? I mean, you have to just ensure in your trust deed and in your shareholders agreement, if you are able, if you have other shareholders, you would put it in your shareholders agreement too, maybe in the articles of the company. You want to make sure to walk through the definition of an employee ownership trust in the Income Tax Act and make sure that all of the things that are required will be in place. So you just do it as part of your setup. You just ensure that anything that would throw you offside is not going to be effective. Yeah, I think that's the best you can really do. You can't guarantee it, right? There's no way to make absolutely certain that, when you hand over control, could the trust do something that it's not supposed to do? Yes, but again, you'll set it up so that the departing owner or the advisory team or whoever it is going to set it up so that it's easy to stay on track. Okay, what are the restrictions on amortization of the payment? Is there a maximum time limit to pay, or is there a maximum time limit for the seller to claim any CRA-related items? So if what we mean by that is how long can I get paid back? Like if I give what we call a vendor note, or we do vendor financing, which means basically I'm going to get paid out over time for my shares. I'm put my shares in the trust, and then the trust or the company is going to pay me back over subsequent years. In the ordinary course, when you're not doing an EOT, there's no time limit per se, but you have to recognize that gain on those shares over 5 years. That's the sort of maximum period over which they're going to let you. So if you get paid back 1/5 per year over 5 years, then you can just recognize the money as it comes in. If you're going to get paid back slower than that, you have to recognize the income and pay tax on it that fast. You still have to do 1/5 a year for 5 years. That's the ordinary course. In an EOT transaction, you can do it over 10 years, so 1/10 per year for 10 years, which is a lot nicer. You can get paid back, again, slower. So I wouldn't say there's a 10-year time limit on getting paid back. You can get paid back as slow as you want, CRA doesn't care. But you're going to have to pay tax on it on that schedule. Or whenever you get the money, if that's faster, right? So if you get the money faster, then of course you have to pay tax on it faster than that.
Except that if it has the exemptions engine, then
yeah, exactly. So if you're exempt, you're exempt, right? So you just claim the whole exemption in year one. So if you're selling a business for $10 million or less, or actually it could be, I'll say 11 and a half, or if you have family, and I say that because you get your lifetime capital gains exemption too. So, and maybe if there's family members involved, you could wind up multiplying the lifetime capital gains exemption, but let's say 10 to make it simple. If you're selling your business for $10 million, you'll recognize the full $10 million gain in year one for tax purposes and claim your exemption against it, and you'll be exempt. And you never have to pay tax on any money that comes to you out of that loan, basically. So I don't think there's any. I'm not sure exactly what the question is referring to about a time limit to claim CRA-related items. I guess I would say you do have to claim the exemption in the year that you make the transaction in order for it to be effective. In theory, you could, if you didn't know you were making an EOT transaction, you could go back and file a previous year or something like that. But that's very unlikely that you'd accidentally create an EOT. So,
and St. John, let's say the business sold for 18 million.
Yep.
And the 10 million is immediately exemptable. The 8 million that's being paid back over time, that would have the 10-year horizon that you would have to recognize that within the 10 years. Yep.
Correct.
So people have that clarity.
So you would choose to, in that case, what you do is you choose to recognize 10 in year one, and then maybe you do 1 per year for 8 years or something like that, right? Whatever you think ideally what you'd actually, like the rate you might actually get paid back at would be great, because then you're not going to wind up paying tax on money you haven't got yet. But yeah, that would be the ideal. What are the personal tax implications for the seller in the year of sale, assuming the capital gains exemption is used? Well, your first 10 million is tax-free. So if you sell for 10 million, the whole thing is tax-free. If you sell for 20 million, your first 10 million is tax-free, and then your next 10 million is taxed. You'd pay tax on it just like any other sale. Now, again, if you're not getting that money on day one, you can spread it out, right? Like we talked about. But you would usually claim as much of the exemption as you could in year one, just because why not? Okay, what are the personal tax implications for years after the sale, assuming the capital gains exemption is used? So again, you're going to actually, even if you're getting paid back, so whatever you're getting paid back over time, you're going to have to pay tax on that.
That's over and above the capital gains exemption that's used.
Yeah. Well, because presumably you will have, exactly. So you'll have recognized as much of the gain as you can to get the exemption in year one, and then in future years you'll have to recognize a portion if you're getting paid back a portion. Okay, if the OpCo shares, and for the benefit of listeners who may not be, I suspect everyone knows OpCo, HoldCo, but OpCo is short for operating company and HoldCo is short for holding company. So a lot of times it's very common in Canada to have corporation that is an operating company that runs the business, and then the shares of the operating company are often owned by a holding company, and then the ultimate owner owns shares of a holding company. So if the OpCo shares are owned by a holdco, what mechanisms are in place to allow the sellers to utilize the capital gains exemption? So what this question is getting at is who gets the capital gains exemption. The $10 million is only available to an individual who sells shares, not to a company. So if Holdco sells shares of OpCo into the EOT, nobody gets the $10 million tax exemption. So what you generally would do is you would sell the Holdco shares into the EOT, and that ensures that then the ultimate individual is going to be able to get access to that capital gains exemption.
And so from a planning perspective, you want to make sure that you've taken any other assets that are in the holdco out ahead of time to be able to do that.
So if you've got what we call keeper assets in your holdco, you gotta get those out. You gotta purify your holdco before you sell it. And sometimes that can be painful. I say painful meaning there may be tax to pay in order to get that to happen. I think a lot of people, we talked about pitfalls earlier, and I think one of the pitfalls is sometimes people seem to think that they should be able to get those keeper assets out on a tax deferred basis, and that I would say that's usually not going to be possible. Usually you're going to actually have to realize your gain on them. But always talk to your accountant, because your accountant may have some solutions for you. Or they may say, you know what, you're actually kind of at a wash on some of these assets, so maybe don't, we're not really talking about a lot of extra tax because you've got some losses that you're going to realize, you've got some gains you're going to realize, it'll be fine. Can the seller claim both the $10 million capital gains exemption and the lifetime capital gains exemption? Yes, you can. The $10 million has to get shared among your family, but the lifetime capital gains exemption is per individual. So you could even find a way, if you've got a family, it's very common to have your holdco shares owned by a family trust. If you purify your holdco, you might distribute those holdco shares from the trust out to your different family members to make sure that all of them get to take advantage of the lifetime capital gains exemption. You can really maximize that way. Would a sale of holdco shares qualify for the lifetime capital gains exemption? Yes, again, assuming that you purify, assuming that it meets the requirements. There are various requirements, mostly to do with what the assets are. If your holdco has an awful lot of non-active business assets, meaning basically more than 50%, you might be offside for a substantial amount of time. There are two different tests, asset tests at different times. So one kind of looks at the preceding 2 years and says, okay, well, over that time, were you at least half active business assets? And then you also look at it right at the end and say, okay, you're at least 75%. So you wouldn't have a separate buy-sell agreement for the beneficiaries, but what you would have is you would have a share purchase agreement by the trust. The trust is going to buy the shares, and that's separate from the trust deed.
It could be expedited. So a year is like average. We've seen these things take shorter. We've seen them take longer. It really depends on the complexity of the company, the design, what needs to get set up ahead of time, how quickly your lawyers and accountants move. We're headed into summer right now, and everything just slows down. So, I haven't seen a lawyer turn around legal documents in less than a few months. So that's part of what creates that. No offense to lawyers. These things are very detailed and important documents. You don't want to get them wrong. And then there's also the education and communication that is a really critical piece. And so we really work with companies to not only design what's going to go into the trust deed, but also work with the team so that they understand what that means. And that's like the owner team, the management team, the employees, like at all different levels. This has implications for people in their work, and that takes time. And so I would actually argue that a quick flip of a switch is a harder thing for a company to adapt to, right? Like it's an adaptation, it's a transition. It needs time to like simmer in your company to be able to come to real fruition. And I think that's, to be honest, part of it is you need that
Yeah.
time.
And I'll add on to that, Iqbal, in terms of how long it takes to set up an employee ownership trust, if all you want is to like create the trust, I mean, I could have one of those to you next week, right? Like that part's easy. It's the share purchase, the actual purchase itself takes time, and due diligence is another aspect of that. But I think the biggest thing really is the most important thing that the biggest benefit to like making sure that you give this plenty of time to breathe, is, like Jennifer said, on the management side, on the governance side, making sure that people actually kind of understand what's happening and what their roles are and all that kind of stuff. If you don't need to claim you also asked if you don't need to claim the $10 million exemption, would it still take a year to set up the trust? It still takes time to get everybody trained up on what their roles are going to be. Certainly on my end, on the legal side, I would say if you're not looking for that $10 million exemption, that does make my job easier. A lot of the complexity really comes from making sure that that's available, especially with regard to any sort of pre-transaction reorganization. So it's often going to be required to get that $10 million exemption. You will often have existing sort of ownership structures that are not going to be compatible with an EOT sale. We're going to have to kind of reorganize everything and get it all, but that all has to happen on a tax deferred basis. So it can be kind of complicated. And so if you don't need the $10 million exemption, that does make my job a lot easier for sure. Default, I'm not an employment lawyer, but the trust is a separate entity from the company. And so insofar as the employee is owed anything from the company in respect of their employment, that actually happens independent of the EOT. It doesn't matter if it's an EOT owned business or not. From ownership down, it's the exact same as any other business. Very traditional sort of governance model. Directors, shareholders appoint directors. Directors run the business, right? Insofar as outside of employment law, in terms of the trust deed itself, it'll depend what the trust deed says. So if the trust deed says, employees get paid out when they leave, then yeah, you might have to pay them out when they leave. If your trust deed says former employees get paid out over time, well, a fired employee is a former employee, so they might get paid out over time. And you can write the trust deed in different ways to kind of accommodate that, but you'll have to that will be one of the things that you'll walk through with somebody like Jennifer in terms of thinking about, how do we want to design this? If you want to have this sort of capital interest that belongs to beneficiaries, then yeah, you'll have to think about that. You could also just say, of course, and I think this is what's been common so far, is we're not doing a capital, the capital interest only comes up if the trust is dissolved. And otherwise, there's no capital interest in the trust. And if you do that, then yeah, you just won't get your distribution this year, or maybe you will, depending
on what the trust deed says.
Yeah, depending on what the trust deed says, exactly.
Yeah. So you do need to plan into the trust deed some mechanism for when they're released as a beneficiary that something is supposed to happen.
If the trust deed is silent on it, you would just read it and see what it says, right? So for example, so far what I've seen, it's not unusual to have your trust deed basically just say, hey, if you're an employee on this day, you get paid. Okay, well, if you're not an employee on that day, you don't get paid. That's it, right? That's just what the trust deed says, and that's how the trustees are directed to act. So,
okay, great, thank you.
And in our case, so most companies right now, because the internal capital accounts are so complicated and we don't really know how they're going to work, most companies are doing what we are calling naked in, naked out. So people aren't putting equity in. So they're benefiting from distributions through dividends, but they're not benefiting from equity growth. So that whole valuation question goes away, Warren. And then in the trust deed, we are writing into that what happens if someone leaves, and in certain situations, right? And what happens about their distribution, but also what happens if there's a sale, because those are treated differently, right? So say someone retires and there's a distribution. Well, a lot of companies we work with want to then have employees still get that distribution, or they might have multiple years of distributions. But if the company is sold, they may think differently about that. So those are some, like, these are the things that are like in the design that people like you don't think about, but this is partly why the design takes time, is because we work on these details to make sure that we've covered all these elements so there isn't confusion at the time of these things happening later on.
Yeah, you go ahead, Jennifer.
Well, I was like my last client's legal trust deed was 52 pages. So like it's like there's a lot of things. It's hard in this context without like, I think maybe for a different EOC thing we could prepare a list, but there are a lot of things. I don't know.
Yeah, I would say the biggest things to look out for are, number one, you got to meet the definition in the Income Tax Act. So just follow the definition, make sure you meet it. Make sure you don't wind up without trustees. That's one to look out for. There are a couple of things decisions or events that like require a vote of the beneficiaries. It's not very common, but it is important that it be in there. And that's actually a very complicated problem. It's actually a very challenging legal problem to solve. So you got to make sure that your trustee solves that, that sort of like quandary. Those are some of the things that I would say look out for that. But like Jennifer said, there's an infinite amount that you should, I guess, be on the lookout for. Yeah.
Typically for independent trustees, yes.
That's a great.
And even for employment, like employee trustees, you could, right? I mean, you could pay the trustees. The Income Tax Act doesn't really say anything about that. Good question. The answer is it depends. Sorry, I'm a lawyer. I got to say that. So if the U.S. business division is part of the business, so if it's like just it's under the same corporation and is operated as part of the business, and these are just employees in the U.S., at least 75% of your beneficiaries have to be Canadian residents. So if you want to get the $10 million benefit. So I would say it's possible, but watch out for that. That's a thing I want to be very careful about. And again, you might almost go into you might go overboard, putting limitations on the company to ensure that they don't hire too many US people, fire too many Canadian people until you're clear of the clawback and whatever, right? You'd want to be careful about it. But the answer is fundamentally, you can do that and they can be beneficiaries. If it's in a separate corporation, again, they won't be beneficiaries. The U.S. employees of this, foreign subsidiary won't be beneficiaries, but they could. That doesn't necessarily throw the whole thing offside if it's a small part of the Canadian business. So if the value of those U.S. company shares are less than 10% of the value of everything held by the trust, that could actually still be okay. Is there a minimum time? I mean, it depends on how much purification you have to do. So if the holdco is more than 50% non-business assets, then you got a long waiting period. You're gonna have to wait, I think, 2 years. Off the top of my head, I think that's right. Similar to a lifetime capital gains exemption. If it's a small amount, then no, there's no waiting period. You would just make sure that it happens. You could even have it done, at the same time. You would just sign the documents in order and say, okay, well, this is the order it's going to happen in.
As long as the holdco that exists is still holding the assets in the opco, right? Like that, yeah. If you're moving to a new holdco to purify, you want to leave, like, depending on what people are trying to purify. But if you're leaving into the existing holdco, yeah.
Okay.
Yeah. Well, and you wouldn't want to move the shares, to be clear, you wouldn't want to move the shares of OPCO because that actually this is another thing that might be a bit of a pitfall or whatever. If you move the shares of OPCO into a new holdco, well, now you've just actually sold you've actually transferred the shares, right? And now sure, you get your $10 million tax exemption, but on tax of $0 because you actually already have to pay the tax before that happens. So.
Usually our clients will go back and have the valuator do an update, which doesn't require a full valuation, but it gets an updated valuation.
Thing is anything that would cause 25% of beneficiaries to lose status as beneficiaries. So in reality, that's going to be big firings, right? Like laying off a lot of people. It could also be things that would throw the company offside of being an employee ownership trust. So, for example, I mentioned that 75% of the employees have to be Canadian, residents. So, hiring a ton of foreign employees, could in theory be something that would require an approval of the beneficiaries. If you got anything else, Jennifer.
Well, I was just going to say that we do recommend that the board of directors and the council of trustees have a good relationship, so that there is dialogue and communication. There is a way to best practices are that is not like a siloed approach. So that there is room for best practices to be implemented. So if there is something that the beneficiaries are feeling very strongly about, and that goes to the trustees, and the trustees can raise that with the board of directors, like there are channels that can be built there. But that's more of like best practices of communication and collaboration.
I wouldn't advise doing another kind of trust. Like if you don't want the $10 million exemption, you still can do an EOT. And an EOT may still be a phenomenal option for you. I've got folks who are not eligible for the $10 million exemption because they're talking about professional corporations, which are not eligible, or where you've got foreign owners. So some U.S. owners have come to us to say, hey, we want to spin out our Canadian subsidiary. Can we put it into an EOT so that none of our competitors are going to buy it, right? That's an interesting option. They're not eligible for the $10 million exemption, and they're still going to do an EOT. I wouldn't set up a different kind of trust. And the reason I say that is because one of the big benefits from the trust's perspective of being an employee ownership trust is it's not subject to 21-year rule. So trusts under the Income Tax Act have to pay tax on the increased value of their assets every 21 years. So if you imagine a business owner who every 21 years has to pay tax as though they had just sold their business at fair market value, like that's brutal. You would never do that, right? You'd have to wind up selling machines in order to pay tax on the value of those machines. Like you would never want to do that. So I would say setting up a different kind of trust, probably not the route to go, but an EOT might still make sense.
Or you could do some sort of employee ownership structure where you could have a holdco that the employees come and go to the holdco. Like there are other employee ownership models that could be applied to that. Legislation is quite firm on how that there has to be equal treatment. So there can be difference in how. I see
I was going to
lawyer.
say, my immediate reaction to this is yes, it can be different, but it can't be different in the way that you're articulating here.
Exactly.
So there are only certain things you're allowed to consider. So you're only allowed to consider basically tenure, other time worked, and then total compensation. So other remuneration. So you certainly could say, okay, well, let's make it so that someone who's if someone who's working in sales versus in the office, are receiving different compensation, then yeah, you can make it so that they receive different proportions of the sort of income of the trust. You can't say, but it has to be on that basis. It can't be, I want, all my engineers to get paid 60%, and I want, you can't do it by like job title. That wouldn't be allowed.
Yeah. And that's typically one of the things that we help figure out in the design based on how, which of those levers and or a combination thereof makes the most sense given what you're trying to achieve in your company.
So assuming you're talking about from the owner, to the owner, like debt being paid from the company or from the trust to the owner, no, interest is not going to, that's going to be just regular income interest, like any other income interest. Interest income. Yeah, so that'll be exempt. Sorry, that won't be exempt.
Yeah.
That'll be taxable just like any other interest. The one thing I will say that raises an interesting point, I talked about sort of pre-transaction reorganizations, that kind of thing. One of the things that we would generally recommend is under your EOT, you're going to create this trust and then create a company in the trust, a BuyCo, who's going to actually purchase the shares. And the reason you do that is because if that BuyCo is the one who borrows money to make the purchase of those shares, that's going to be, the interest on that loan is going to be deductible. Whereas if you do it directly in the trust, I'll say it either is not certain or you should consider it taxable. So
That's really interesting. Well, I think that we'll stop there. Thank you so much, St. John and Jennifer. This was so great. I really hope everyone got some questions answered, and I'm sure we'll be doing more of these. So thank you so much to both of our hosts, and thanks to everyone who joined. And there's a survey. Please fill out the survey, and maybe make a note. Let us know if you'd like to see more of these. That would be really helpful. We're not sure what frequency to do this at, so if you could fill the survey out and let us know what frequency you think would be good. We would love to know that from everyone in attendance. Thank you
Thanks,
so much.
everyone. Take care.
Thanks again, Jennifer.
thanks, everybody.
Thanks.
Bye.
Bye.
Thank you.